Okay, guys, good evening again to everyone and welcome to this bootcamp training. Today's our first day for the training, and so we're just going to get familiar with what Forex is because most of us are completely new to Forex. So we're going to start with the basics. We're going to start with the basics right up to the advanced level in the course of the training. So welcome to everybody. I hope you guys are doing great. So let's get started. My name is Gospel Young, right? So you can call me that. I'm the mentor here in Jugos FX community. Now, let's just start. I don't want to waste so much of our time. Okay, and I don't want to make this video to be too long since it's a recorded version, so that those who will not be able to join, they can watch the video later. Okay, so let's start off immediately. Everything that we are trying to do here is, I mean, forex at large, it's simply foreign exchange, right? You just from the name, you're exchanging money to get another one. That is, if you have dollars, like you can see on the screen here, if you have dollars, you can exchange euros for dollars, right? So that is simply what forex is, but we are going to go to look at it detailedly. We're going to look at it detailedly. Okay, like, all right. So let's go. What is Forex trading? Like I said, I made this presentation so that because somebody like I explain a lot of things so that at least it should give me a path to follow so that I don't take so much of your time just trying to explain things and so on. So Forex, just in short, is foreign exchange. Okay, it's just an abbreviation that we call it Forex, but the full meaning is foreign exchange. Okay, and it is a global marketplace where currencies are traded against one another. Like you could see from here, if you have dollars and you need euros, you exchange it with somebody. Okay, so Forex started long time ago, and it was not just main on currency pairs. It even started during the times of slave trade. Right? If people bring money and they take slaves, just like that, and that's how uh, that's how trading has been since then. All right, just if you have let's say you have fish and you need something like beans, you exchange it with somebody. But now during those times there was like a lot of cheating because if you have fish, you will not actually know the amount of quantity that you need to give to somebody to take beans or something else from the person. All right. So now with that time, it was not really that stable. So we moved from that time now to gold, and gold was used as a standard for exchange, which means that if you have corn and you want to exchange it with gold, gold was the main standard. Okay, gold was the main standard that was used for exchange. Like you say, okay, this amount of gold can get this amount of gold can get this. Okay, so that's how trading has been since then. But now we moved on to now the dollar index. I mean the dollar, which is now made it is the most used as a standard of exchange. Most people use it as a standard of exchange. Like if you want to change euros, you use euros to exchange your data, or you use the value of the dollar, use the value of the dollar to exchange, okay, to exchange euro. So that's simply how trading since then has started until it now came to this level where we as participants now are like retail traders. We are able to trade in the foreign exchange market. I'm going to explain this furthermore as we get into the training. All right. So, but as I said, Forex is just the short form of foreign exchange, which is a global marketplace where currencies are traded against each other. Okay. Now, it is the largest and most liquid financial market in the whole world with an average daily trading volume, which exceeds $7 trillion. Okay. It actually exceeds $7 trillion. What does this mean? This means that the amount of money that is circulating within a day, okay, within a day it's more than $7 trillion. Okay, it's more than $7 trillion. So now what this means is, let's say we have like let's say we have a marketplace like in Cameroon, and then let's say this particular today was like a market day. Right now, you discover that maybe during the market session, right, during the trading, or how people are buying and selling goods and services throughout that particular session, all right, or the Cameroon market, maybe the money that have been circulating is about 1 million US dollar, okay, about 10 million US dollar, or let's say 50 million US dollar. So that's the meaning of the average trading volume. Okay, so it exceeds 7 trillion. This makes it actually the highest, the biggest market in the whole world, which means in a particular day, the buying and selling of currencies exceeds $7 trillion, and that's a whole lot of money. Okay, so now just key points about forex trading. Currencies are always traded in pairs. For example, Euro USD, where the first currency euro is the base currency and the second currency US dollar, okay, is the quote. Now, what do I mean? If you don't have two things in your hand, there will be no way for you to exchange. All right, you cannot exchange something as the same with the same thing. All right, you cannot, if you have just the dollar, how can you exchange with the dollar as well? It cannot work like that. So you need a different thing to be able to exchange. That is why I said from here, foreign exchange market, the currencies are always traded in pairs. For example, we have euro. This is euro, and then you exchange it with US dollar. All right, you have euro, USD. You have so many other, all the currency pairs that are being paid into pairs. They call it pairs, or they're being paid two of them. Right. That's, if you want euros, you can exchange it with a dollar and so on. That's how they are being paid. Right, where the first currency, which is the euro, in this currency pair, the first currency, which is the euro, is a base currency, and the second currency, which is US dollar here, is the quote currency. Okay, so forex trading involves speculating on the price movement of currency pairs. Traders aim to buy at a currency pair where, when they anticipate it would appreciate in value, and sell it when they expect it to depreciate. Now, what does this mean? This means that if you want to buy a currency pair, you actually need to buy it at a cheaper rate, expecting the value to rise. Okay, and the value of the currency to rise, it fluctuates a lot. There's so much liquidity that this gives ease which an asset can be bought or sold without causing any significant price change in the market. Now, what this means is price can easily buy as fast as possible, and it can easily sell as fast as possible. You understand? So that's how the foreign exchange market is very, very liquid. It's very, very liquid. So in a space of like an hour, a currency pair can appreciate in value, and it can depreciate in value as well, which means if it wants to appreciate in value, you buy. If it wants to depreciate, you sell, and you make money on both sides. If the value of a currency pair is going up, you can buy. If it is going down, you sell, and at the same time you can be able to make profit. So this doesn't just mean that if prices are going up, that's the only time that you can make profit. No, if the market is going up, you can buy, and if it is coming down, you can as well sell, and then you still make profit. Okay, so it's either you buy or you sell, you make profit on both sides. Okay, that's how the foreign exchange market is. Those are the important things, the important parts of foreign exchange market. Okay, you buy when it's going up, you sell when it is dropping, and on both sides you can be able to make profits. Okay, so let's please, as I'm discussing, if you have your questions, you can keep them coming, and then we'll get to them later. Right, so this is just a brief introduction about what forex is. Okay, simply the exchange of currency pairs, one against another. Right, that's simply what forex is all about, the exchange of currency pairs. Like I said, the currencies are paired in twos, all right? It's a pair. You cannot exchange just a single currency with a single currency. You need two currency pairs to exchange. And now, how do we make money exchanging pairs or buying and selling currency pairs? That's what we are going to get into, and because that's the main thing we are interested in Forex for, okay, to make money. So is Forex trading actually profitable? I guess so. And many of you that have joined this call, you must have been asking if actually it is profitable. Okay. At this point, if it wasn't profitable, many of us wouldn't have joined, right? If it wasn't really that profitable, we wouldn't have joined, because that's our main purpose here, to make money. Like, we're learning a skill because we want to make money. Okay. Okay. So let's move on. So what are the advantages of Forex trading? The first one is accessibility. This is the best part of it. This is the best part or the best advantage of Forex trading: accessibility. The Forex market is accessible to traders around the clock, 5 days a week, allowing the flexibility in trading hours. Okay. This is the best part of it, but this is not actually my best one actually, but like I said, it is a very good one, because it could be like, there are so many type of businesses that are limited to particular countries, right? But with Forex trading, it can be accessible anywhere, anytime, okay, within the 5 days of a week. All right, because the market opens on Sunday night, that's 10 p.m., and it closes on Friday. Okay, so 5 days a week, you can access Forex trading anywhere at and any time. Okay, now again, we have leverage. Forex brokers offer leverage, allowing traders to control larger positions with a small amount of capital. Now, let me tell you a very interesting part of this. Okay, at first, we as individuals who could not be able to participate in the foreign exchange market. Why? Because it needed lots of capital. Okay, it needed lots of capital to be able to participate. Now, what happened was, now they introduced what they call brokers, which is like an intermediary firm, which offers you the opportunity to be able to control large amounts of money in the foreign exchange market. Now, this means that you can deposit as low as $10 in your account, and you'll be able to uh trade a position that is almost like $100, right? You can be able to trade a large amount of money, all right, but meanwhile you have deposited something very little. Okay, like I said, at first only people with huge capital, like 10,000, $1,000, $10,000, $100,000, millions, but those are the kind of people that could participate in the foreign exchange market. But now, with the introduction of the brokers, we as individuals, now you can now deposit like $10, $5 into your Forex account, and you'll be able to make profits from it. Okay, so that's the important that's an advantage of Forex trading. You can deposit like $1,000, and you'll be able to manage a trading position of about $100,000. All right, so now the next one is diverse trading opportunities. So traders can choose from a wide range of currency pairs. Now here you have, there are almost everything is traded in the foreign exchange market. All right, even the Zoom as we are using, the shares are being traded in the foreign exchange market. Okay, the shares are traded in the foreign exchange market. We have Google, the shares are traded in the foreign exchange market. We have these beans that we cultivate. We have corn that we cultivate, wheat, soya beans, all of these things, all these stocks, gold, commodities like gold, silver, bronze, all of them are being traded in the foreign exchange market. Okay, as we go on, we're going to see this type of assets that are being traded. Okay, so it's a diverse trading opportunities. Give us diverse trading opportunities. Like, you cannot just trade currency pairs, but if you want to trade only currency pairs, that's fine. If you want to trade stocks, if you want to trade commodities like gold, silver, and so on, you'll be able to trade it. Okay, but remember, this trading is done online. Okay, it's done online. You can be able to buy gold. You say buy gold, you make profits, you sell, you make profits, and so on instantly. Okay, instantly. But now, like just a physical part of forex trading is like if you go to the airport, that's a very easy example. If you go to the airport to if you go to the airport and let's say you're from Nigeria and you have a naira, you're going to USA. Now you go to the airport, you need to exchange your naira, all right, with the dollar, so that since you're going to America, you won't be using the naira there. So you have to exchange it, and exchanging it now, that's simply forex trading. You are doing it practically or physically. All right, that's simply trading. You are doing physically, and that particular transaction that you're doing, somebody is going to make profit from it, and the person that's making profit from it is the person that is exchanging it for you. Okay, let's just say naira is let's just say one naira, $1 is equal like uh 500 naira. Okay, now if you go to the bank, like, or in the airport, like, okay, I want to travel, I want to exchange nairas to dollars. Now the bank will tell you that, okay, we are going to exchange $1 for you at 700 naira. Okay, I mean at let's say 300 naira, which normally the transaction is about 500. So if they give you $1 with the rate of 300 naira, they're going to be making profits from that transaction. That's simply how forex trading is. You exchange something. If you want, somebody want to sell you something, you buy it at a cheaper rate, and then if you want to give it back to somebody, you give it at a higher rate. So which means that if you go to exchange your naira to have dollars, and then you go to America, you come back later, and then you still want to exchange the dollars that you brought to naira, they're still going to take it from you at a cheaper rate. So which means whether you go back and forth, they are still going to be making lots of money from that particular from your transactions. Okay, so that's simply how forex trading is. That's simply how forex trading is. You buy, you make profits, you sell, you make profits. All right, we're going to go deeper to this, and you're going to understand. So low transaction cost, it's actually there is absolutely the transaction costs as compared to other financial markets make it attractive for retail traders. Now this one is actually my best part, the global nature. So being a decentralized market, forex trading is not tied to any specific location or exchange, enabling participants from all over the world to participate. Now, the sweet part about this is like you can actually trade this just from your bed. Okay, like sometimes I just get up, maybe I'm still like sleeping. I just open the market. I say, okay, you see that you have made $100 while still lying on your bed, and you have the whole day to relax and do other things that you want to do. Okay, that's the advantage of forex trading. You don't have to be glued to an office or to work 247 for somebody like a 9 to 5 day job, like you go in the morning till evening. No, it's not like that. For me, as I trade in a day, 1 hour is enough, sometimes 30 minutes. I can make $100 in just 30 minutes looking at my charts and studying the type of currency that I want to trade. And in the next 30 minutes, I've traded $1,000, $50, $500, and then I'm off for the day or for the week. Okay, that's the best part of foreign exchange market. Susie is writing on my screen. Okay, so that's the best part of forex exchange. Those are the advantages. Those are the things that makes forex trading so attractive to people. So the key participants in the foreign exchange market, who are the people that are participating? Here we have the central banks, which are the highest people that are participating in the foreign exchange market. The central banks here, they're not actually trading to make money. Okay, they are not trading to make money. They are trading here to stabilize a currency pair. Like recently, we heard that the naira was so cheap. All right, naira was so cheap. Now, with the central banks, if they come in to trade this naira, they are not actually coming here to make money. They just want to stabilize, because for a currency pair to be too cheap or to be too low, if the exchange is too low, it is very bad for the country. Okay, it's very bad for the country. Now, let's say at the moment, $1 is like 650 francs. Okay, now let's say in the next 1 hour you see $1 equal to 1 franc. That is low, and it's going to affect the dollar very, very badly. So the central banks are here to stabilize it. They're there to watch if for the currency pair not to go too low or not to go too high. Okay, so we have as well the commercial banks. We have the commercial banks, which are the major players in the foreign exchange, as they facilitate currency exchange for their clients and conduct large trading. It's like, for example, let's say China has a project in Cameroon which costs like $5 billion dollars. This type of business cannot be handled with physical money, right? They need to exchange it with the commercial banks or the investment banks and so on. All right. So we have investment banks, we have corporations, we have hedge funds, we have retail traders, which are individual traders. All right, like us, and we have governments, we have speculators, who are the traders who seek to profit from short-term trading decisions. Okay, so those are the key participants, and this is where we are retail traders. All right, we are like individual traders, often referred to as retail traders. So we participate in the foreign markets through online trading platforms. All right, provided by brokers. Remember, I said at first you could not be able to trade because of the what was needed to be able to trade was a huge capital, but now brokers are there to help us. Okay, brokers are there to help us. Know more about this as we continue the trading. Like brokers now, you can be able to trade in the foreign exchange market through a broker. Okay, through a broker, while the individual trades have relative small impacts in the markets. So that is those are the participants in the foreign exchange market. So the key players, like I said, we have the central banks, institutional investors, companies, individuals, brokers, and so on. We have commercial banks. So these are the main players in the foreign exchange market, and this is where we are sitting. Okay, this is where we are, the commercial banks. This is where, I mean, the individuals, this is where we are. And then this is our foreign exchange market. Remember, I say these people, they are just there to stabilize the currency, not for it to be too high and not too low, because if that is the case, it's going to affect the currency. Okay, it's going to affect the currency pair, the currency itself. So now, as we started, I said currencies are paired in twos, right? It's all about a pair, not a single currency. You cannot trade, you cannot exchange just a single currency. So in forex trading, currencies are traded in pairs. These pairs are categorized into three groups: majors, minors, and exotics. All right. The major currency pairs here are the pairs that consist heavily traded and widely recognized currencies in the world. Okay, now we have these are the major currency pairs, the most traded, right? Like I said, almost every country they have a currency, right? So, but we have the most traded currency pairs, which fall under the major currency pairs. And the first one in the list is Euro USD. Okay, Euro USD, like you have this Euro stands for Eurozone, and then USD stands for United States. Now we have USD JPY. USD JPY here, right? It stands for US dollar, and then we have Japanese yen. All right, the first two letters stands for the country name, and the second one stands for the currency name. Okay, so we have GBP, which is Great British Pound, right? The United Kingdom, and we have US dollar, which is the United States. We have USD CHF, which is Swiss franc, Switzerland, right? From Switzerland, which is a Swiss franc. We have USD CAD, which is United States Canadian dollar. We have AUD, which is Australian dollar, USD, United States dollar, right? We have NZD, which is New Zealand dollar, United States. So all these currency pairs are traded. All right. As we move on, we are going to see how we can be able to trade these pairs. Okay, we're going to see how we can trade these pairs. Now, remember, I said major currency pairs, they are selected because of the most with a currency that consists of the most heavily traded and widely recognized, well recognized, like the US dollar. So any currency pair that you see US dollar in it is actually a major currency pair. All right, it's actually a major currency pair. And any currency pair that does not have the US dollar, it's now the minors and the exotics. Okay, so these are the most traded currency pairs. Now, here we're talking about the exchange rates. Okay, let's talk about the exchange rate. Now, exchange rates play a fundamental role in forex trading as they determine the value of one currency relative to another. Okay, you cannot exchange euro with the dollar if you don't know the value of your euro. Okay. If you don't know the value of the euro, you will not be able to exchange it with the US dollar. So if you have the value of the euro, let's say the value of euro is like $1, and then the value of dollar, $1 is like 1.5 euro. And if you're exchanging euro with the dollar, you're actually going to make no profits because the value of euro is actually very cheap. Okay, it's cheap with relative to the dollar. So if you're exchanging the both of them, it's like you are giving somebody 100,000 to take 90,000. It will not actually make sense, right? So it's good to know the exchange rate, and we're going to dig deep to that when we go into to the charts. Okay, so let's go to the we're going deeper now to forex market analysis. Now, when like say you can buy and you make profits, you can sell and you make profits, what how do you feel like you cannot be able to determine all these things? Now it comes into forex market analysis. All right, for us to be able to make money in forex, we do analysis. Okay, we do what we call market analysis. Before you can be able to buy a currency pair and make money, you need to do forex analysis. You need to do analysis before you can know if a currency pair is going to go up or come down. Now, the first one on the list is fundamental analysis. We have like three of them. Okay, forex analysis is a critical aspect of successful trading. Okay, traders use different methods to analyze, but we are going to talk on these three most important ones, okay, which is the fundamental analysis, technical analysis, and sentimental analysis. So with the fundamental analysis, fundamentals, it involves evaluating the economic, social, and political factors that influence currency values. Okay. Now, a trader will just look at the currency. Let's say we are looking at the US dollar. We're looking at the fundamental aspect of it, the economy of the US dollar. We are looking at the political factors of the US. Let's just say today, we are assuming like, let's say the president of America is dead. Okay. That's a political factor. And this is going to affect the US dollar instantly. It's going to lose value. You understand? It's going to lose value instantly. Okay. So which means it's actually going to be dropping. All right. And if you are a fundamental trader and this happen immediately, you go into the foreign exchange market, you're going to be selling, you're going to be selling selling the US dollar, right? Now you are selling because you're expecting price to go down. That means you're actually selling at a higher rate and prices dropping down. That's how you make money. You sell and prices goes down, you make money. You buy, prices goes up, you make money. So if a negative news happens, which means the economy is going to be dropping, the value of the currency will be dropping, you're going to be selling. And if there is let's say in America they offer job opportunities to people, to jobless people, right? That's actually a good thing for their economy, which means that it's going to increase the value of their currency. So investors will come in now to buy the US dollar. They're actually buying at the state where it is, and then they're expecting price to increase. Okay, let's say if they buy at let's say US dollar is trading at let's just say at 1, they buy it at that level and they're expecting it to rise. If it gets up to 2, 3, and so on, that's how investors will be making money. So you look at the fundamentals, you look at the economic events that are happening in that particular currency you want to trade. All right, like recently we lost like recently the war in the war that started in Ukraine and Russia. If you go into the foreign exchange market, you notice that as this war started, it actually affected their currencies, it affected their economy, all right, which means their currency has been losing value. Okay. if your currency is losing value, investors who invested in your currency, they are going to be removing their investments, all right? And then which means your currency is going to be dropping. And as a forex trader, you are going to be selling, all right? You are going to be selling. Now, you'll be asking me if you are selling, when did you buy to have Russian rubles before you'll be selling? No, it's not like you need to buy something before you sell it. The amount of money that you have in your account as a deposit, you use it, all right? Let's say you deposit like $10, okay, and you discover that the dollar is going to be dropping. It already means that you have $10, right? And as you are selling, you're going to be making profit. The $10 is going to be increasing, okay? That's it about fundamentals. Just looking at the economic, social, and political factors, all right, that will influence a currency's value. Like I say, the most important one, the most clear example is like the death of a president. It's going to affect if there's a war in a country, it's going to affect the country very badly. All right. So there is second one, which is technical analysis, and this is the one we going to focus more on it, which is technical analysis, all right, which involves studying historical price charts and using various technical tools to identify patterns and trends in movement of price. We are going to go deep to these particular ones, this particular technical analysis as we go forward. Now, sentimental analysis also is also known as market sentiment, all right? So this one is just like traders, they're trying to gauge the overall sentiment or emotional outlook of the market participants towards a particular asset. Let's say as we are 100 people here, we look at the market and we're like, okay, this currency has dropped so much and it has dropped so much, and then it's soon going to start to rally back up. Those with sentimental analysis, that's where you start to buy, okay? You start to invest. Like, for example, those who do crypto, you will notice that Bitcoin has dropped so much, and using sentimental analysis, you will know that it has dropped to a certain level that at least it should start rallying back up. That's just sentimental analysis, okay? So let's continue. Like I said, we have three, and then let's see what fundamental analysis is about. It talks about gross domestic product. Okay. Okay. The economic indicators here, we have inflation. All right. Inflation represents the rate at which the general level of prices for goods and services rise over time. Like most of the time we hear in Nigeria, they cry that fuel has increased, stuff like this have increased. That's inflation, right? That's inflation. And if the prices of goods and services are increasing, it's actually going to affect the currency pair. If they are dropping so much, it's going to affect the currency pairs. Now, interest rates, all right? Central banks use interest rate as a tool to control inflation, all right? So it stimulates or low down economic growth, all right? So we have employment data, right, which is how many people have been employed, how many people are jobless, and so on. So we have some news releases like non-farm payrolls, unemployment rates, job creation numbers, provided insights in. Now, there are actually websites that you can get all this data from. Okay, so we have central bank policies, political stability, market sentiments applying. Now, this, you don't have to crack your head so much on this. Okay, you don't need to crack your head so much on this. This is just the theory part. I'm just explaining to you so that when we get to the key points, which is our technical analysis, linking back to fundamentals to look at some key things on it, you will not be surprised. Like, you never knew about this and so on. Okay, so you are going to be aware that we talked about this in the past. So it's just for you to have forex trading is not about theory, okay? But as a newbie or as a beginner, it's important for you to know these theories. It's important for you to have an idea of this theoretical part or one of the basics. Okay, so like with technical analysis, is based on price charts, okay, which are primarily tools used in technical analysis. The most common of charts are, we have bar charts, candlesticks charts, and so on. We're going to go deep to that. All right. So now, like I said, with sentimental analysis, it involves market participants' opinions, perceptions, and sentiments to gain insights in potential market trends and price movements. You're just like, okay, this particular asset has dropped so much, and if you are thinking like that, normally most of the traders will also be thinking like that, right? So they'll be thinking that, okay, this is happening, this has happened, we should be expecting this, and so on. So those are the things that happen. And then with sentimental analysis, you'll be able to know when a market will start buying or will start selling. So now this is technical analysis. Like you have what you see here, this is a chart. Okay, this is a chart with candlesticks. So this is what we are going to be doing more like most of the time. This is actually where our main focus will be. All right, and then part of it too on fundamental analysis. Okay, so we're going to be going, like I said, our main focus will be on technical analysis and fundamental analysis. All right. So with technical analysis, as I said before, we are going to be dealing with charts. And this is a chart. All right. This is a chart. So we look at this, we look at charts. Okay, we look at charts here to determine whether price will rally up or down. Like you can see here, price rallied right up to this point, and at this point it was selling. Okay, now as it was dropping, this is actually a currency pair, the US dollar. As it was dropping, if you sold from here and it drops down to this point, you're going to be making profit. And if you buy at this low and then as it's going up, you're going to be making profits as well. So you'll be making profits on both sides. Like I said, it's not like you wait until it sells to a certain level before you buy. No, if you discover that it's going to sell, you sell it, and as it's going down, you'll be making profits. If you discover that it's going to buy, as it's buying, you're going to be making profit. But how do you determine that? That's the purpose for technical analysis. How do you know when a currency is going to start buying? How do you know when it's going to be selling? That's what we are going to be doing when we go deep to technical analysis. Okay, that's when that's when you're going to understand it very well when we go into technical analysis. Let's go to the next slide. Clear my drawings. Okay. All right, if you're following up, please let me see that on the chat box. If you guys are following up, please let me see that on the chat box. Okay. Okay. All right. Thank you, guys. Thank you. Thank you. Okay. Okay, so let's go to the next slide. Remember, I said, please don't be afraid. Okay, this theories is all about theories. It's just for you to know the basics of what is going on. Okay, it's not like when we start trading, you will not need all these basics. You will just need this honorable chart here. You just need to look at this and you know that this is going to happen. You sell, you make profits, you buy, you make profits, and so on, and then you are done for the day. Like this particular move, this particular move did not take up to 30 minutes to happen, which means that if I was looking at my laptop or my phone in the next 1 hour or in the next 30 minutes and I took a buy trade from here as it goes up, I can be making $10. I can be making $100, a $1,000, and so on. There will still be somebody who bought from here, and the person will be making 1 million US dollar, 100,000 US dollar. Some people will be making billions. People like hedge funds, they were making hundreds of millions with this same trade. Okay, this now actually depends on how much your account balance is. We are going to go deep to that, and you understand why a trade like this, I'll be able to make $100. Somebody will be able to make 1,000. Somebody will be able to make 1 million, and somebody will be able to make 1 billion on this same trade. Okay, somebody will be able to make just $10. on this very trade. So we are going to, as we are going further, you are going to understand why that can happen. Okay, so in the space of 30 minutes, somebody can make $10 on a same trade, another person make 100, another person make 1,000, another person make 100K, all right, another person make 1 million, another person make 100 million, another person will make 1 billion on the same trade. Like I shared with you guys on the group about George Soros, which one of the best traders in history, took a trade and he made 1 billion US dollar. Okay, 1 billion US dollar in a single trade. All right, and it was around 30 minutes. So those are the things that we're going to you are going to understand as we go deeper into technical analysis. Okay, so let's go again now. Here we go. Before we actually go into technical analysis, here are forex terms that you have to get familiar with. Okay, you have to get familiar with. You have to get familiar with these few terms. Like it's like a language. If you want to learn a skill, you need to know about some few things about it. Like, let's say if you want to learn building, you need to know the tools, the names of the tools that you're going to be using, like spirit level, water level, square, line, and all those stuff. So you need to know their names and what it can be used for, right? So we have some few terms that we are going to get familiar with them. This is not called for you to cram. You don't need to cram them, right? You just need to understand that this is what this is all about. This is what this is all about. Okay. Now, a pip. The first one is pip. Okay. What does this pip means? It means percentage in profit. Now, the smallest price move that a given exchange rate can make based on market convention. All right. So most currency pairs are quoted to the fourth decimal place. All right. So, and 1 pip is typically this. This is 1 pip. Okay. This is 1 pip. This is how 1 pip is calculated. This is 1 pip. Now, this is an exchange. This is a currency exchange. Okay. This can be Euro USD. This can be Euro USD. Okay. Euro dollar. Now, this is the exchange rate for Euro USD 1.15382. Okay. Now remember I said here that they are quoted to the fourth decimal place. You ignore the fifth digit here. Okay, you just ignore it. Just make as if it's not there. You just have to ignore it. It's a pipette and it's not actually it's not valuable. All right. So you end at the fourth digit. Right, you see the 8 here with a red paint, right? And we have there as 8 pips. Okay, if you want to put this into this, you are going to be having 0. All right, you have your point, you have 0, you have 0, you have 0, and then you're going to be having 8. All right, and that's going to be 8 pips. Like I said, here is 1 pip, and then if you bring 8 pips to here, you're going to consider this as zeros, and then you'll be having 8 pips. Okay, and if that's the case, right? If that's the case, now you will notice why you have here 30 pips. Now this 30 pips means that from here, this is 3, and then we have 0, right? That's going to be 30 pips, which means that we joining these two is going to be like it'll be 38 pips. Now 500 pips, which is 0, 0, you are going to be having 500 pips. Now putting these figures, you're going to be having like 538 pips. Now we have this, which is 1000 pips. If you put 0 here, 0, 0, you're going to be having 1000 pips. But if you want to put all these figures, you're going to be having 1538 pips. Okay, remember I said we ignore the fifth digit. You don't count it. All right, you ignore the fifth digit. So we're having 8 pips here. If this was 1, if we could be having 1 here where 8 is, that would be 1 pip. All right, and then 3 will be now like 31 pips. So that is how pips are calculated. Now this is the same thing there. This is how the movement is. You have 1.1498, right? Remember I said you neglect the last digit, which is the feed one. Okay, now if a currency pair moves from 1.1498 up to 1.1499, this means that it has given a movement of 1 pip. Okay, we have had a movement of 1 pip. It has moved from 1.1498 to 1.1499. We're having a movement of 1 pip. Okay, so now like this, here is like 499 pips. So what if we have 500 here now? Okay, meaning that we have 1.14948 to 1.1500. Now, how many pips will this have moved? Let me see that on the chat box. If we have 1.1498 to 1.1500, this is 500 pips here. 500 pips, and then here is 498 pips. This will mean that this has moved up how many pips? Okay, I want to see the answer on the chat box. How many pips will this have gone up with? 2 pips. Okay, 2 pips. Great. 2 pips. That is simply the calculation, guys. That is simply the calculation. Another example is if you have 1.1222, right? Remember, we neglect the fifth digit, all right? So we have just fourth digit after the decimal point. Now, if you have this and then price move to 1.220, what will this mean? This will mean that the price has dropped by 2 pips. Okay, instead of going up, we have dropped by 2 pips. So which means 20 pips here, we're having 22 pips here, and then we are having 20 pips instead here. So it means that price have dropped 2 pips. So we're having a minus of 2 pips here. Price has dropped price has dropped 2 pips. That's how the movement of prices are. Okay, so a movement from a digit like this one to another one is called pips. It's measured in pips. Okay, it's measured in pips. So you are going to everywhere you're going to be hearing about pips, and pips, because from one number to another, it's measured in pips. Okay, it's measured in pips. It's like a builder, their measurement is centimeters or meters, but the measurement in forex is pips. Okay, even your money will be calculated in pips. Okay, you're going to know how much 1 pip can cost. All right, you're going to know how much 1 pip is equal to, okay, in dollars. You're going to know how much 10 pips is equal to in dollars, so that if you enter a trade at 1.1498 and it moves up to 1.1499, you will know how much this 1 pip is going to be giving you. Okay, so that's how trading your pips, or that's how your money will be calculated, and that's how you do your measurement. It is all in pips. Okay, it's all in pips calculation. It's a pip calculation. It's measured in pips. The smallest price move that a given exchange rate can make based on market convention. Most currency pairs are quoted to the 4th decimal place, and 1 pip is typically this. Okay, so let's continue. Now, this is where it gets interesting. Now, like I said, we have 1 pip has its movement. Okay, 1 pip has its movement, and so on. But now the next topic that we have, all right, the next term that you have is lot, L-O-T. It's a lot. We call it lot sizes and so on. So with the lot is standardized. Let me see. Please get lost. Okay. Now, a lot is standardized trading unit in forex. Okay, the size of a lot varies by account type, but the standard lot is usually 100. So we have like the main three types of lot sizes. We have three types of lot sizes. We are actually four, but we concentrate on the three types. Okay, the standard lot, the mini lot, and the micro lot. We have this. We have standard lot, we have a mini lot, we have a micro lot. Okay, so those are the main three that we are going to focus on: standard lot, mini lot, and the micro lot. Now, these are the units of the lot sizes, but this is how you are going to see them on the trading app that we're going to discuss later. Okay, so standard lot has $100,000. All right, you can call it units or you call it in dollars. So we have a standard lot which is $100,000. We have a mini lot which is $10,000. Yeah, we have a micro lot which is $1,000. So this means that if you are trading and you are using the standard lot, it means that you're actually controlling an amount of $100,000 in the market. If you're trading using the mini lot, you're actually controlling an amount of $10,000 in the market. If you are trading using a micro lot, you are controlling an amount of $1,000 in the market. It's like you go to the market, you have like $100, and they like, okay, they say you can purchase things of $1,000. That's simply like how forex trading, a lot size is all about. Okay, so now you will notice here that with the standard lot, if you want to use the standard lot, like I said, which is 1.00, one pip movement, with this type of lot size is equal to $10. What this means is that as I stated here, okay, as I stated here, this one pip movement here with a standard lot was supposed to be, is going to be giving you $10, and you can take a trader to give you 100 pips in 2 minutes. Okay, that can give you 100 pips in 10 minutes in one day. So which means that if you take a trade and it gives you 100 pips and you took the trade with 10 with the standard lot, which means that one pip is equal to $10 dollars. You're simply going to take $10 times your 100, which is going to be $1,000. Okay, you'll see that you're going to be making $1,000 with that particular short movement. Okay, that's simply how it is calculated. Now, if you are using the micro lot or the mini lot size, that's simply the calculation. You will now ask yourself how much one pip movement is equal to this. Like I said, if we are using let me use this. I don't want to use, let's use this line. Okay, let's say we are using the standard lot. All right, and the standard lot says that one pip is equal to $10, and we took a buy trade, and the buy trade gave us 100 pips. It gave us 100 pips. So we are simply going to calculate $10 times 100 pips. Okay, times 100 pips, and this is going to be giving us $10,000. Okay, it's going to be giving us $10,000. All right, you're just taking no, $1,000, sorry, $1,000. You take the zero to the other side, and that will be $1,000. Now, if you take the trade, if you take the same trade with a mini lot, all right, one pip here with a mini lot is equal to $1. Your 100 pips here will give you $100. Will still give you $100, not 1,000 again. So now this is why I said at the beginning, when I showed you that chart, like, okay, I can take a trade and I'll be making $100. Somebody will take the same trade and be making just $10. The difference comes in with lot sizes and your account balance, because there is you need a certain amount of account balance to be able to use a standard lot. All right, we are going to go deep to that and you understand much better. All right, so now we have The standard lot, 1 pip movement with the standard lot is equal to $10, right? 1 pip 1 pip movement with a micro lot is equal to $1. 1 pip with a standard lot is equal to $10. 1 pip with a micro lot is equal to 10 cents. All right, 10 cents. So that's simply how the calculation, it's not that hard. All right, it's just to have it in mind. Just to have it in mind so that when you are trading and a trade goes in your direction for 10 pips, you will know that, okay, this is what I should be expecting if I was using this type of lot size. You will know that, okay, if I enter a trade and my target is to have 20 pips in this trade, this is how much I'm going to be expecting if I use a standard lot or a mini lot or a micro lot. All right, it is that simple. So now let's go to the next one. We have bid and ask price. Okay, the bid price is the price at which you can sell a currency pair, and this ask price is the price at which you can buy. The difference between these prices is known as the spread. Now, like I said, the brokers, you can trade in the foreign exchange market through a broker. Now, how do these brokers also make their money? They make their money through spread. Okay, they make their money through spread. Now we have the bid price. Is the bid price, like I said here, is at which the buyer is willing to buy. So if you want to buy a currency pair, you're going to be using the bid, the ask price to buy. All right. I hope you are getting. Now, price at which the seller is willing to sell. Now, if you're selling, all right, if you are selling, you're going to be using the ask price, and then if you're buying, you'll be using the bid price. Now, this is your bid price and this is your ask price. The difference between the bid price and the ask price is what we call the spread. All right, the spread here is what the broker stands to gain, okay, in your transaction. So, like I said, if you want to buy an asset, you use the ask price. You're going to be using the ask price. If you want to sell, you're going to be using the bid price. Why is this so? Let me give you an illustration. Now, the first one here is 1.4079, right? Then the next one is 1.4081. This is actually higher than this, and the difference is 2 pips, okay? The difference is 2 pips, which is the spread. If you should take this and minus this, you should have 2 pips, which is the spread. Now, what this means is that you, in your trading, you're going to have 2 lines. The first line, okay, the first line down is the bid price. The second line up is the ask price. If you want to take a buy, trade, the broker is going to initiate your trade on this ask price. Okay, remember the ask price is higher than this, which means that the ask price is this, okay, is 1.4081, and then the bid price is this one here. Okay, now if you want to sell, the broker is going to initiate your trade on using the bid price. Okay, and now when you open the position, like the difference between this and this, like I said, is the spread, which is the money which is the commission your broker takes to manage your position in the market. Okay, is the amount of money the broker takes to manage your trade in the market, which is called the spread. All right, it's called the spread. Now, that should not bother you so much. Like I keep saying, these are just theories, right? Now, the next one we have here is the leverage. We have leverage. This is this illustrates the leverage. Okay, it is still linking to your broker. Okay, you can have $1,000 in your account and you use a high leverage. All right, you use a high leverage of like 10:1, which means that you actually want to trade a position in the market that is equivalent to $10,000. Right, we have leverage. We have like 1:2,000. All right, you have 1 is to 2,000, 1 is to 1,000, 1 is to 100, and so on. This is what makes Forex very interesting. You can have just $100 in your account and you use a high leverage and you'll be able to manage a position of a higher amount, which means that, let's say, in practically, if you have $1,000 and another person has $10 in his $10,000 in the account. Now, both of you take the same trade with this. If those both of you are taking the same trade, this person should be making profits more than you, right? Because your account balance is small and his is big. But now, if you use a high leverage here, if you use a high leverage, like let's say you use a leverage of like one is to 100, which means you should be multiplying this by 100. You're actually going to be controlling a position that is more than this person's if this person doesn't use a high leverage as well. Okay, so leverage gives you the opportunity to trade a small amount of to be able to trade large amounts of money while your deposit or your account balance is quite little. All right, so that's the function of leverage. Now margin here just simply stands for this particular deposit in your account. All right, you need the amount of money required to open and maintain a trading position. Okay, it is just a portion of your account balance set aside as a collateral. So you must deposit something in your account before you can be able to trade. That is called a margin. All right, so you need something in your account to be able to manage this type of to manage a larger amount of money. Okay, it is called a margin. Now we have stop loss, we have take profit, long position, and so on. Let's get to that one. Let me clear my drawings. Okay, we have take profit and stop loss. Take profit and stop loss. Now this is another very most important part. With this, if you neglect this, you will never make money in Forex. Okay, take profit and stop loss. Before you take a trade, you should know where price is going to. All right, that's the first thing you need to know. Before taking a trade, you should know where price is going to and why price is going to that particular direction. Now, if you want to buy, like you can see here on my left, which I said buy order. If I'm placing my buy order here, I will be able to answer why I want to buy. Okay, why I want to buy and not sell instead. If I want to sell, like I said, sell signal, enter a short position. When you say short, it's like you are selling. Going long is like buying. All right, you go long, it means that you are buying. You go short, it means you are selling. Those are just synonyms. Okay, now with the buy order here, if you place your buy position at this point, that means you're expecting price to go up. Now, your take profit here, it's like you are giving a price level for price that, okay, to the broker that you should close your position when price gets to this particular point. Let's say we have 50 here, we have 20, and then we have 10. Now, price is currently trading at $20. Now you take a buy trade here, expecting price to go up to $50. Now you can put your take profit, okay, at $50, which means that you are telling the broker if price should go up to $50, close the trade for me. All right, you close the trade automatically and send the profits to my account. So now, if price leaves from $20 to $50, how much will you be making? That's roughly 30. You are making $30, right? And then the broker should close the trade for you automatically. So which means that 50 here stands for your TP, take profit. Okay. And here is your entry. Your entry is at this point 20. Now, what you're going to put at this 10 is what we call stop loss. This is what we call stop loss. And stop loss is very important. As you're still beginning, you will never place a trade without using a stop loss. Okay. You should never place a trade without using a stop loss. But now, what is this stop loss all about? Stop loss means that, okay, if you place a buy trade and the market does not go up and it wants to instead go down, all right? Now, if you place a trade at $20 and price drops at $10, you are literally going to be making a loss in that particular trade. It is very practical, like in the sense that let's say you go to Germany to buy a car You go to Germany to buy a car and you buy a car at 5 million US dollar. Now you come back to Nigeria to sell the car, and they tell you that the prices for the car now is 4.5 million. You're actually going, if you sell the car at 4.5 million, you're actually going to be making a loss. All right. So the prices of that has dropped. So which means that if you buy a currency, you buy Euro USD at $20 and it drops instead to $10, you are going to be making a $10 loss. All right. Now, but why should you put a stop loss? This means that this particular pair, as it's dropping, it can drop till it reaches $0.00, right? So, but now you say, okay, if price doesn't want to go up, I don't want it to go below $10, and that's where you put your stop loss. If price should be going below $10, your broker now is going to close the trade for you automatically. Your broker will close the trade for you automatically. All right. That's it. Your broker will close the trade for you automatically. You will not need to. If you're looking at your phone or your laptop, you can be able to close the trade manually. But if you have put your stop loss and your take profit, if price should go to it to your take profit, your broker is closing it for you and sending the profits to your account. If you should go to your stop loss, your broker is going to be closing the loss for you. Okay, protecting your capital for you. All right, that's the importance of stop loss. It's protecting your capital. All right, so let's get to the next part. So now, let's study this. With this one, we're going to be having an assignment which will be submitted tomorrow as we continue. So how to use MT4 and MT5. What is even MT4 and MT5? All right, these are trading platforms. Okay, these are the trading platforms that we use to be able to trade in the foreign exchange market. Now, at this point, you guys should follow Candy, because you're going to download these apps into your phones or your laptops, and we're going to be using them to trade. Okay, so how do we use them? We have this one here is your MetaTrader 4. It's called MetaTrader 4, MetaTrader 5. All right, so you should have any of them installed in your phone or laptop. Okay, so now inside your MetaTrader 4 or MetaTrader 5, if you open it, you should have something like this. Okay, we have this, we have this, we have this, and then this. The most effective ones that we're going to be using are these ones here. Now, the first one, the first pop-up menu here shows you currency pairs. Like you can see here, Euro USD, GBP USD, USD, and USD GPY, and so on. This first one, if you click this first one, this is it here as well. If you click this first one, this here has been highlighted, right? That's why you see currency pairs, you see charts. Now, if you want to see a chart, you can see the next one here has been highlighted. All right, the next one here has been highlighted. You're going to see to be able to analyze and know if price will be selling or buying. Okay, if you haven't just your phone, you click on the chart, you analyze. Well, I'm going to show you how to analyze and buy or sell. All right, so you show if you go to the chart menu here, you're going to see charts to be able to analyze. If you click here, you're going to see your account balance. Okay, let me meet some people to the group. Okay. So we want to create a MetaTrader 4 or 5 account. Okay. We want to create a MetaTrader 4 or 5 account. Now, once you've downloaded this app into your phone, whether MetaTrader 4 or MetaTrader 5, if you open it, all right, I think if you open it, you're literally going to see something like this already with the balance, this and so on. But I want you to create how to create a demo account. What is the demo account? It's just an estimated money, okay? It's not real money. It's just like it's paper money. Okay, they give it for you to be able to practice with it, to practice how to trade. with it before you can be able to deposit money now and start trading. So as of now, everybody is going to be having a demo account. You're not going to be opening a real account yet because you don't know how to trade. You're going to be opening a demo account to practice. You use it to practice first, right? So how do you open a demo account? Now, like I said here, if you look at this point, these are the, like I said, okay, when you click here, you're going to be having your account balance. If you click here on the charts, you're going to be having the charts to analyze. Click on quotes, you're going to be having your currency pairs to analyze. But now, when you open your MetaTrader 4, it's going to look something like this. And this is where you're going to click these three dots here. If you click these three dots, you are going to have something like this. All right, you're going to have something like this. These are brokers here. We have Raw, Trading, LT, MetaQuest, XNest, Technology, TFT Global Markets, and so on. These are brokers, like you can see here, brokers. But now, we need a demo account, all right? You can use a broker's account, which will do that later on in the training. But for now, we're going to focus on using the MetaQuest Software Corporation. This is uh this is the demo that comes with the MetaTrader 4 or MetaTrader 5. So you can click here, you click on MetaQuotes software, right? You want to create a demo account. So you just click from here. Once you click here, it's going to open like this. You open a demo account, and then you have MetaQuotes demo and so on. So you're going to fill in your first name, your second name, your phone number, you fill in your email, all right? And then you see here you have a leverage, take 1:100, right? Account type, MetaTrader and demo, and then deposit. You choose your account balance. Here I choose $10,000. You can choose $100,000. You can choose as much as you want, but I prefer choose a little the amount that you can be able to deposit, okay, so that you practice with it. Now, once you do that, you scroll down, you're going to see accept, and then when you click accept, you're going to see register. Once you click on register, you're going to have your demo account details, which is, for me, my name is Gospel, second name Young, account type Forex deposit $10,000, and now you have your login and your password. Okay. Now, investor password. This investor password means that you can have somebody, you can give this password to somebody to be monitoring how you are trading. The person will not be able to trade, but you'll be seeing how you are trading. Now, this investor password is used by people who manage accounts. Okay. Now, like you can have for some people who don't know how to trade and they want people to trade for them. Somebody can give you like $100,000, okay, for you to be trading for the person. Now, this is what you're going to give to the person, an investor's password. He is going to be monitoring the profits that you are making, okay? But he cannot open a trade, but he's just going to see how you are trading. If you take a buy trade, and when he opens the MetaTrader 4, he's going to see your buy trade, okay? So once you have all this, you take done, and then you should now have this, all right? You should now have a balance and an equity and a free margin. Now, if you should click uh if you click on this trade or with the currency pairs, or like a currency pair on top of a currency pair, you are going to have this. This is where your lot size is. Here you have stop loss. Here you have take profit. Like I explained recently, your stop loss is where you don't want price to go below. All right, your take profit is if you buy from somewhere here and you want price to go up to this point, you can place your take profit at this point. Okay, but if you don't want it to go, if it doesn't want to go up and it's going back down, you should place a level where you don't want price to go and pass, so as to be your SL. All right, so we have your lot size here, like I explained. You need a lot size to be able to trade larger amounts of money in the foreign exchange market. But this comes in with an account balance. All right. We're going to discuss more on that as we continue. An account balance, you need a particular amount in your account to be able to use a specific type of lot size. All right. You cannot have $10 in your account and you are using 100, you are using a standard lot, right? So those are the things that are necessary when you want to determine the type of lot size that you want to use. All right, so let's go again. Now you should have a demo account, right? Please, you are going to follow this and you create your demo account and then we work on it. All right, so we're going to be downloading MetaTrader 4 and MetaTrader 5, and then you try to create your demo account and you send it to me on the group. So congratulations, we have completed the theory portion. Now let's move on to the exciting part, all right, diving into the charts to uncover where the potential opportunities lie and where profits can be made. Okay, now it is the chart time. This is where the magic is. This is where we're going to be making money, looking at the charts, not reading theories up and down. Okay, so guys, that's it about the theory part. That's it about the theory part. And I think if you have a question, so many of you have questions. I'm going to give like 30 minutes. 30 minutes too much. Let's just see the number of questions that you have concerning anything that I've explained. And then anything that I've explained and you didn't get it well, then let me see a question. Please say what amount of capital appropriate for each lot size. Okay. Which amount is appropriate for each lot size? All right. Let's say in the course of our thing, we are going to do more on that. But just as a start, if you have $100 as your account balance, you cannot use a standard lot. All right. You can start with a micro and a mini lot, which is 0.01 and 0.10. All right. These are the lot size that I can use if you have $100 account. If you have $100 account, you should never use a standard lot. Okay. Now, as from $1,000, that's when you can use a standard lot. That's when you can use a standard lot. But now, this is how I do it. Between $100 to $1,000, you can use a micro lot, a micro lot, sorry, which is 0.10, right? Which is 0.10. And between $1 to $100, you can use a mini lot, which is 0.01. Okay, so that's how it is. From $100 to 1,000, you use 0.10. From 1,000 to as how much as you want, you can now use standard lot, 1.00. Okay. So that question was from Myromi. Let's see new questions. What is the best currency? Base currency pair is simply the first currency in any pair. Like we had Euro USD. Euro is a base and US dollar is a quote currency. So when you have two currencies paired together, the first one is always the base currency and the second one is the quote currency. So, okay. So please, can you close the WhatsApp? Okay, thank you. I did that already. I'm following up. Okay. If you have a question that you need to talk, you can tell me. All right, you can let me know. Thank you very much, sir. So please, how do I create a demo account using MetaTrader 5? Okay, truly it is different because I downloaded MetaTrader 5. What if press false? Okay. All right. Some of you clear my drawings. Oh. It is basically the same thing, okay? Just basically the same thing. slightly different. Once, whether it's MetaTrader 5 or 4, you should have this. Okay, you should have this. Immediately you open the chart, you should have this. If you open, you should click on trade. When you click on trade, you should have this, and then you click on trade. You're going to see these three icons here. If you click on these three icons, you're going to bring you either to manage accounts and so on. But you should go, your main focus is to create a demo account. If you come to find broker here, you should look, you are going to see meta quotes. This is MetaTrader 5, right? So it's not different. It's the same thing with MetaTrader 4. You should click meta quotes. Meta quotes here is going to open you a demo account. You're going to fill your name and so on, your email, and then you choose your deposit balance. All right. Any other questions, please? If you have questions, we have talked so much about theory. So if you have questions, you can let me know. Okay. Let me permit you to mute your mic and then let's talk. So if you have a question, you can unmute yourself and then you ask. We have 5 minutes for that. If you have a question, you can unmute yourself and then you ask. This video is going to be available very soon. I think maybe tomorrow. So you guys can go over it again. Okay, go over it while taking notes. It's very important. Okay. Anyway, guys, if there is no question, let's discuss more on the WhatsApp group.